Good morning, everybody. Good afternoon to those of you also, and thank you very much for joining today's ICMA webinar on the MENA debt capital markets, as mentioned, focused on developments in the wake of COVID-19 and the future outlook. Now, of course, I'm very sad not to be able to join you in person and to hold a physical seminar, but we're very pleased to be hosting this webinar. One of the impacts of the crisis for ICMA is that we've had to move all our physical conferences, roundtables, committee meetings, board meetings to virtual format. And of course, we do lose the enjoyable and important physical networking aspect. But on the other hand, we can be more agile in providing virtual events more quickly and to a far greater audience than previously. And the range of topics our virtual events cover is very substantial. So I'd really encourage all of you to check them out on our website, as well as the many podcasts. For example, the recent video interview with the CFO of the Islamic Development Bank, a new member to ICMA based in Jeddah. And I'm sure that we'll be discussing later in the webinar many of the topics which are occupying our time and resources at ICMA, largely with a MENA focus and the way that the pandemic has impacted them. A few words by way of introduction. We're all still grappling with the pandemic and we're longing to resume normal service once it is behind us. It is indeed a terrible disease. But from a capital markets perspective, there are some positive points to take away, and we're going to explore these today. Firstly, the combination of concerted and coordinated central bank intervention and fiscal measures calmed the intense early volatility and illiquidity and has allowed the capital markets to function well. It's really the first time that we've seen such concerted international cooperation. It simply wasn't there in 2008. Secondly, since then, despite many market participants in all functions working remotely, the markets have operated smoothly. And it was unthinkable even last year that this could be possible for such a long period of time. Thirdly, digitisation and fintech have really saved the day. Fintech is now impacting the way we operate in every segment of the capital markets, and we only expect this trend to continue. Communication tools are an example. Today we're using Zoom, but fintech applications are developing at pace in primary markets. In the secondary markets, electronic trading has been growing for many years, and in repo and collateral, the number of fintech solutions has grown dramatically. Green tech and reg tech are also developing themes. At ICMA, fintech is a cross-cutting priority. We're working to foster innovation and to ensure that there's good communication between market participants and the solution providers so that needs are understood and met on both sides. And data harmonization is also a major topic. Again, take a look at our website and you'll find a suite of directories of fintech applications in all the market segments we cover. These are very useful and they're a unique resource in the market. Fourthly, the megatrend globally is sustainability. ICMA continues to provide leadership in the sustainable bond markets by running the Secretariat of the Green and Social Bond Principles. And what have we seen this year? Well, the pandemic has been the catalyst for explosive growth globally in the social bond markets, where the proceeds are used to mitigate the negative impact of the pandemic. Socioeconomic support, such as unemployment support, healthcare research, healthcare access, etc. Alongside this, the green bond market continues to grow, and it's really great to see environmental considerations hardwired into the economic recovery programs to rebuild shattered economies. Build back better. It's also been a year of innovation in sustainable bonds, with the launch of our new sustainability-linked bond principles to support this new growing segment of sustainability-linked bonds. It's very exciting, and I'm sure we'll touch on this. So overall, we feel very encouraged by the progress in the sustainable bond markets and the fact that sustainability has developed into such an all-encompassing policy objective. Globally, the LIBOR transition moves along to meet its end 2021 deadline. This is a hugely complex task with many geographic and product interdependencies. And ICMA's focus is on transition in the bond markets, and that in itself is already highly challenging, particularly in dealing with legacy bonds. And all of this comes on top of what I would call the bread and butter of our work, making sure that our standards, documentation, and guidelines in the primary markets, the secondary markets, repo and collateral, and the sustainable bond markets are always up to date in interacting with our members, working with regulators on forthcoming regulation and the implementation of new laws. And the mandatory buy-in topic and repo transparency under the new SFTR are just two recent examples. And I know that we'll touch on a number of these topics and how they pertain to this region during the panel today. And we'll be discussing how the MENA debt capital markets have grown this year, including substantial new issuance from sovereigns, but not just sovereigns. Look at the planned Saudi Aramco issue and the outlook for the future. This is an exciting part of the world, and we're very pleased to receive so much input from our regional committee, which is chaired by Fawaz Abasnani from First Abu Dhabi Bank. We very much appreciate the work that he and his committee undertake in guiding our work in the region, deciding what events we should hold, and to promoting our extensive suite of education courses. And I'd also like to mention how pleased we are now to have an ICMA board member based in the Gulf, and we'll be hearing from Amin Belhaj Sulami, based in Bahrain, for BNP later on. And again, I'd very much like to thank in advance all of our speakers and panelists. So that concludes my opening remarks. I'd like to introduce our first speaker today. His name is Simon Ballard, and Simon is the Chief Economist at First Abu Dhabi Bank. I think we all know that a good understanding of the economic backdrop is essential for all serious capital market practitioners. But the pandemic has made the work of economists, namely to understand the economic impact and perhaps predict the future, unbelievably challenging. But given the situation, this is more important than ever. So Simon, we're very much looking forward to your comments. Welcome and thank you again. Over to you.
Ladies and gentlemen, good afternoon. It's a great pleasure to speak to you virtually as part of this ICMA webinar this afternoon. I have a small presentation which I have titled, Dare We Look Beyond COVID-19? Because I believe that is the big question post the uncertainty around the US election that characterized the end of this year is very much the topic that we will be debating for many months to come as we move into 2021. I've been afforded 20 minutes or so to offer you my thoughts on 2020, but more importantly and interesting, at least I hope, my outlook for 2021. There have certainly been, from a global markets perspective, if not from the global perspective in itself, we've been preoccupied and dominated by one event, of course, this year. That is COVID-19, the coronavirus. But with increasing optimism with regard to finding a vaccine, I'd like to suggest that the pandemic is still the big question for next year. But as per the title of my presentation, the question is, dare we look beyond coronavirus? Will that vaccine be the game changer that we all need and pray for? Ladies and gentlemen, for all our sakes, I certainly hope we can count on that as we move forward. There have, of course, been myriad factors driving volatility and investor uncertainty during the course of this year, 2020, all concurrent with those spiraling and spreading coronavirus infection numbers. And as we look on slide 2 here, we see the coronavirus in the top left, the lockdowns of which have triggered recession. We've seen sort of plunging equity and risk markets. We've seen commodity markets battering amongst themselves with oil, grain, etc., taking its impact on the global economy. Here, as well as around the globe, we've seen the impact on social mobility, airlines being grounded, hospitality being closed, retail being shuttered, and the economic impact that that's had on GDP. We've swung from an expectation of steady global growth in 2020, which we imported from 2019, to the acceptance of a deep and painful recession through much of the global economy, other than perhaps one country, namely China, paradoxically, which will be the only major country within the G10 and within the larger industrial space that will show positive growth for 2020. We then, of course, had the controversy, the uncertainty, and the amusement surrounding the US election back in November. Sillet bang being my my favorite part of the cleansing away from coronavirus. But all of this coupled together has meant that the world has been turned upside down. But today we sit here looking at still spiraling, exponentially rising coronavirus numbers around the world. 55 million cases globally, over 11 million of which are in the US and across parts of Europe as well. So we really do need to keep working on containing the virus until a proven vaccine is found. We felt the painful effects, as I said in that first slide, of the economic lockdowns and social distancing this year, the response to which governments and central banks has been absolutely unprecedented. As you can see here on my fifth slide, interest rates have been slashed dramatically, and fiscal stimulus measures have been implemented that have seen sovereign balance sheets balloon exponentially. We've approached the zero bound, if not exceeded the zero bound, on interest rates globally. And as I say, fiscal stimulus has blown sovereign balance sheets up to historic highs. Moreover, with coronavirus numbers continuing to rise at a rapid pace, there were 70,000 reported cases of COVID-19 hospitalizations in the US alone on Monday this week. This is a monetary fiscal dynamic that doesn't look like it's going to change in the near term. But as I alluded to a moment ago, market sentiment has been buoyed in recent days by this course of euphoria and optimism over the latest COVID vaccine trials. And I believe that a vaccine will be the holy grail of improving global market outlook as we head into 2021. And for that reason, financial markets, debt capital markets will remain highly sensitized to all headlines purporting to vaccines, success rates, failure rates, side effects as we move through the latter stages of this year and, more importantly, the early days and the early months of 2021. Couple of vaccine with zero bound interest rates and that extensive fiscal accommodation that we can see in the chart here, and consequently a more buoyant macro outlook for next year and indeed 2022 should continue to feed a renewed bear steepening of the yield curve going forward. And here we can see the relationship between 530s treasuries, 210s treasury curves, and the steepening that we've had from the inverted nature that we touched at the back end of last year before we realized that coronavirus was going to justify that weak and inverted nature. As optimism has spread, so we've seen that re-steepening of the curve, that future expectation of a return to growth from deep recession. And that again is something we expect to continue as we move into 2021. Although I would just caution somewhat that I believe the market has got a little ahead of itself in terms of all this talk about a V-shaped recovery. There will be no V-shaped recovery. It will be a shallow U-shaped recovery at best. And I think we need to condition our thoughts and expectations ready for that. It's also important to note that as a result of the stimulus measures implemented in the US and over the past 10 months, that there's now an eye-watering amount of treasury issuance on the calendar for December in order to fund the stimulus measures that have been put in place since the early part of this year. And that funding will continue through until early next year. That eye-watering amount of treasury supply will clearly put pressure on long-end yields and will give further positive momentum to that bear steepening trend as we move forward in the future months. As per slide 7 here, stimulus and zero rates has also driven a clear divorce between fundamentals and valuations this year, with central banks' backstop bids continuing to drive investors' enthusiasm and commitment towards risk and yield. Recent macro data has shown that the recovery from Q2, the nadir of the cycle, but we're still in firm negative territory for the foreseeable future. And on the interest rate side, we know that we're in a low for longer situation as far as the Fed and as far as the Bank of England and the ECB are concerned. And that again is going to continue to, and we have a revised inflation outlook from the Fed that is going to continue to drive confidence in risk assets in the short term, that we have central banks that have our back, in inverted commas, as we move through the unwind and hopefully the eventual containment of coronavirus. But nevertheless, we're in recessionary territory for this year. We acknowledge that now. And that, as I said earlier, is a 180-degree swing from what we were broadly expecting this time a year ago. If you recall, when we came into 2020, global markets, global economists were generally expecting that 3% trend growth of GDP to be maintained through 2020. The US economy was seen as remaining robust. That 3.5% unemployment rate that the US was so proud of was expected to perhaps soften a little bit to remain solid. The European story was expected to see further recovery with the ECB maintaining rates at zero, if not negative, with that deposit rate. And global monetary policy itself was expected to remain loose throughout. If we look back now, 9-10 months later, then clearly only one of those impacts has actually happened, and that is that monetary policy has remained loose and indeed has got a lot looser over the course of the last 9 months. So this suggests to me now that investors really need to be adopting a far more discerning approach to risk with a far greater degree of geographic diversification. And here we see, as far as the COVID is concerned, the unwinding element on the labor market in the UK. We had a deterioration and a spike in the unemployment rate. Clearly, we're forecasting a moderation of that as we go forward. We've already seen that in terms of rebounding GDP numbers for the third quarter. But I'd suggest that many of the numbers suggest it's much more of a shallow U than a V-shaped recovery. And the retail sales data that came out of the United States this morning, again, was a lot softer than anticipated. And I think perhaps is a sort of something of a bad omen for what the Q4 aggregate data may look like later in the year. So again, let's step back from that V-shape assumption and let's start pitching ourselves in anticipation of a U-shape, which I believe would be the most positive and sustainable outcome in the medium term. We can see labor markets have had a direct impact on the overall level of GDP. And that, of course, is because of the weight that the consumer carries within the global GDP equation, between 60 and 70%, depending on which economy you're looking at. It's therefore paramount that we focus on unemployment and the labor market as well, and renewed pockets of strength and indeed ongoing weakness within the labor market, as that will help to dictate the degree of recovery that we forecast and expect in 2021. And here again, just referring to that 180-degree swing, you can see that as markets have recovered and rebounded in the third quarter from that nadir of April-March second quarter downturn, we are still some way from recouping all those losses that we had earlier in the year. The debate over possible negative interest rates as a way to try and support the global economy, particularly in the US and the UK, has picked up more listeners in recent months. But we'd argue that there have been limited benefits from such a size, or there would be limited benefits from such a seismic move if the Federal Reserve and the Bank of England were to go down that route. We've heard from Mr. Powell in recent weeks, recent months, that he is reluctant to push what I've wanted to label as the nuclear button for monetary policy as far as the Fed is concerned, that he is reluctant to go into and to consider negative rates territory. And while Mr. Bailey, Governor Bailey at the Bank of England, has mentioned negative rates as a potential tool on his table that he could use should he need to, and he's approached the banks in the UK as to how they might prepare and position for a negative rate scenario, I believe both the Fed and the Bank of England remain reluctant to go down that route unless they absolutely have to. And why do I say that? Well, I look at the ECB that has a minus 0.5% deposit rate. There has been very limited positive impact from that negative rate as far as redressing the imbalances of the Eurozone economy, picking up growth, picking up the ever-eluding inflation that the ECB has been chasing. So I think negative rates in the US and in the UK, controversially, I'd like to suggest that if the Fed were to go negative, they would have to go negative to the degree of about -2 to -3% in order to make cash penal enough to drive capital into higher yielding, higher risk assets with which to try and ignite a deeper and more long lasting recovery as far as economic growth is concerned. Nevertheless, so for now, global rates, at the zero bound, central banks in general now, therefore, I believe, have limited ammunition to deal with any second, if this is still the end of the first, any second or third wave of the pandemic. And the debate will continue, I'm sure, for many months among scientists as to whether this is the second wave that we're in or whether this is just the tail end of the first wave. And in actual fact, any recovery in the early part of 2021 could feed into a second wave as we relax social distancing and some of the economic restrictions that have been put in place previously. Of course, we're already feeling the effects of some of that, particularly in the US, particularly in the UK, and across many parts of Europe, where we were perhaps far too quick to relax and to try and get the economies open again. We should have perhaps locked down, perhaps not sooner, but certainly for longer, in order to try and cauterize this pandemic, this pathogen, more succinctly than the tentative efforts that were made previously. So for the Fed and for the BOE to make negative rates work, as I say, they'd have to go deeply negative. And I think for that to happen, we would have to have a much more significant downturn in the coronavirus outlook for the time being. So we're left here juggling ideas, I guess, as about the shape and nature of the hope for recovery. And as I've suggested earlier, much rather than the much touted, V-shaped recovery, I think the best really that we can expect will be a U-shaped recovery, one in which investors should focus on liquidity, credit quality, and yield. I'd like to show you some of the recent performance that we've seen in the equity markets. And here I'm looking at the S&P 500. And again, that shallow U-shaped recovery with a potential for a further sort of moderation in recovery and growth in Q3 of 2021 leads me to believe that this isn't going to be a sharp linear recovery through the course of next year, but rather stepping stones that we need to feed off as we go through the first quarter, second quarter, and more importantly, the third quarter in general, as we consolidate around the risk still to coronavirus. Here I'd like to highlight, as I say, the focus for investors, I think, going forward will be on liquidity, credit quality, and yield against the backdrop of macro uncertainty, coronavirus, potentially, economic and political question marks as Mr. Biden's administration starts to come in over the course of early part of 2021. That the GCC, the UAE, the GCC credit market will stand out as attractive in terms of its underlying robust fundamentals. That single A credit rating, again, in the middle there against the backdrop of BBB plus peers, and in the bottom left-hand corner as well, the GCC dollar investment grade single A plus index, which again continues to look favorable versus its peers. The bubble sizes in this chart indicating the average credit rating of the index. So therefore, the bigger the bubble, the better the credit quality. So I'll point you in the direction of the large blue bubble and the large gray bubble hiding behind the EMEA red bubble in that bottom left-hand corner. So in general, just to conclude, GCC, I believe, will remain attractive in the context of a still volatile and uncertain outlook. Yes, a lot of optimism is right to be priced into the market as we look towards and work towards the much needed vaccine. But the vaccine, part of my pun, will not be an immediate shot in the arm for the markets over the long term, but something that will need to be proven and tested. I think there will be a reluctance amongst much of the population to adopt and take on these different vaccines in short order, but they will be the cure and the resolution to triggering that U-shaped recovery as we move through 2021 into 2021. There is light at the end of the tunnel. I believe it is positive growth rather than another coronavirus train coming towards us, and on which point I will thank you for your time and your attention.
Thank you very much, Simon. That was really interesting, and some of the points to take away. Don't expect a V-shaped recovery. I think you made that point a number of times, and I think that's probably a very wise advice. We think we've seen the results of the US elections. We haven't yet seen the transition going through, but nevertheless, I think most people are expecting that the Biden administration will be taking over successively and in office in January. In your opinion, what specific impact will that have for the Gulf economies?
I think that's a great question, Martin. I think one of the early reactions for Gulf economies and in general, I guess, for global markets will be a sigh of relief, as you say, that we've come through the uncertainty of November, and hopefully as we get through December, that there will be clarity and that the inauguration takes place calmly and quietly and successfully. A relief rally will come in that we've moved from the Trump administration professionally into the Biden administration. One of the key focus points of late, of course, has been Biden's sort of toing and froing on green energy, how he might treat the US oil industry during the early stages of his administration. That, of course, has sent some fear through the Gulf in terms of what it means for petrochemicals. But I believe if you actually listen to what Biden's been saying, he's very much in line with the diversification story that we've learned and we're developing here in the UAE and across much of the GCC in terms of our dependence on petrochemicals and moving away from that over the next 30, 40, 50 years in favor of a more diversified revenue stream, green economy, as you suggest. So I think it'll be very interesting to see how the debate matures with Biden over the early months of his presidency, and I think he'll be positive for the region generally, albeit that there are sort of geopolitical issues which he'll be sort of perhaps less favorable to, but perhaps less aggressive in terms of his overall posturing versus trade partners. There I talk about Europe and China more than here in the UAE and the GCC, but generally I think he should transition fairly smoothly. He will not be a Biden, he will not be an Obama 2.0, as many people have alluded to. I think he'll have some very positive and strong commitments to make to this region as well as to global politics generally.
That's very interesting. Thank you very much. Perhaps a follow-up question on a slightly different topic. Of course, in Europe, or if we're in the US, we probably wouldn't be spending much time talking about natural resources. But of course, the incredible volatility and price action in the oil market earlier this year was something which amazed many people. What are your impressions of that, and how do you see the interplay for the again for MENA in terms of future oil prices, but also really the impact of natural resources on the way that the economies grow? Are they going to be as bound together as they always have been, or do you see that there are developments so that the economies are a little bit more diversified?
No, absolutely, Martin. And I think, in the short term, very much they'll be tied together. I think part of that diversification, green energy story, they become less tied as we move forward, but that's over the medium to longer term story. I think in the short term, oil prices, commodity prices will remain, hostage to the global macro outlook and expectations. As you say, earlier this year, we saw the sharp decline in oil prices, futures into negative territory, and people were sort of paying to store their oil. And that was a reflection of concerns about impending sort of global sort of doom and collapse led by China, lower demand for oil. We believe that as we go through my shallow U-shaped recovery into 2021, that the oil prices will stabilize and see some modest upside. So we're looking for a modest recovery 2022 with probably upside towards sort of the mid 50s for Brent by the end of 2022. So certainly we think we've seen the downside here, and that in itself, a stable with a modest uptick, will be positive in terms of those fundamentals for the petrochemical producing GCC nations such as the UAE.
Very good. Thank you very much for that. We do have a question from Virginia Furness.
I'll read it here. It says, what will a Biden administration mean for regional agreements with Israel? Will he continue the Trump administration's work to foster greater economic and financial cooperation? That's a great question. And of course, that's been sort of, the top of many people's lips. I think given the big changes that have been made recently with the rapprochement, if you wish, between the UAE and Israel and the opening up of flights, that will continue to be a focus point going forward of the Biden administration, perhaps with less imminent sort of urgency than Mr. Trump had during the latter stages of his. But I cannot see Mr. Biden in the short term, at least, looking to reverse that, given the global applause that largely it's had thus far.
Very good. Well, look, I think all that remains for me to do is to thank you very much, Simon. I meant it. I meant what I said at the beginning. I think you've got an incredibly challenging job at the moment to try and make sense of the impact of the pandemic and what that really means for the future. But it's an incredibly important role for all of us. So we very much appreciate your comments today, and wish you the very, very best of luck in carrying out that important work. So thank you again, and we will let you go. I think with that, we would like to move on to the next phase of the webinar today, and I'd like to hand over to Fawaz Abasnene from First Abu Dhabi Bank, who's also the chair of our MENA ICMA Regional Committee.
Good morning, good afternoon, ladies and gentlemen. For those of you who don't know me, my name is Fawaz Abasnene. I look after debt capital markets at First Abu Dhabi Bank. It gives me great pleasure to be moderating this panel, and thanks to ICMA for organizing the MENA region's first webinar. As you all know, indeed, 2020 has been a roller coaster year. Started on a very strong momentum in terms of capital market issuance. Then we had the pandemic breakout late Q1 with markets being on hiatus for over a month. The MENA region was no exception. We have seen excessive periods of volatility, especially during the month of March, April, and May, and markets have recovered since then. We've also seen the volatility ensuing the second wave of the pandemic, and volatility and then market stability following the US elections. So to give you a background, if you look at total issuance from the MENA region in 2020, year to date, we are at almost 120 billion of issuance. This beats the 2019 record of around 110 billion issuance in the full year 2019. So as you can see, very healthy increase in number of issuances from the MENA region, primarily from sovereign issuers, which constitute close to 60% of total issuance volume, but also from financial institution issuers, both on the senior and hybrid capital side, as well as private placements. If you look at GCC as a percentage of emerging markets, again, the percentage has increased substantially. So the share of GCC top issuers in the top 10 emerging market sovereign issuers is around 37% this year, up significantly from previous years. And this is pretty much due to the mega transactions issued by the likes of UAE, Saudi Arabia, Abu Dhabi, Saudi Arabia, Qatar, and Egypt. So basically, the MENA region has been a major contributor to the increase in terms of volume of emerging markets as a whole. The weight of the sovereigns in the GCC also, and sovereign related entities in the JP Morgan EMBI index, for example, has increased from 2019, where it was around 11.2%. Currently, it's almost 21%. So again, more significant, more meaningful size in terms of outstanding issuance. For investors, and we've seen a number of investors being bullish MENA and GCC paper, the returns for the GCC and the wider MENA compared to emerging market has been relatively stronger. It's a defensive sector based on the indigenous investor demand. And we've seen that, for example, on the investment grade space, the returns year to date have been over 7% compared to 4.8% across the IG EM space. And it's been relatively one of the best performing markets. And in periods of volatility or in market downturn, it has actually been, it has fallen down less. So it's been quite more defensive and less volatile in periods of extreme market downside. So overall, healthy market pipeline, despite the COVID-19 situation, issuance volumes at all record, and we expect this to continue given the liquidity, given the performance of the MENA region in terms of secondary market performance, and which is all positive to our region. Talking about the developments in this in debt capital markets in 2020 and beyond, I'm really honored to introduce my fellow panelists. Mr. Ahmed Abdel Ghani, who is the head of DCM and syndications at National Bank of Bahrain, talking from the origination side, DCM origination side. Mr. Mazen Latki, the head of corporate treasury at ABC, talking from a funding perspective. And Mr. Junaid Anwar Khan, who's the head of treasury at National Bank of Fujairah, who will be talking about the investment side of business. I do really apologize for not being able to join the panel discussions live due to prior commitments. However, on my behalf, my dear colleague and the CEO of ICMA, Mr. Martin Check, will be kindly moderating this panel. Thank you very much for your time. I wish you all the success. Stay safe, and looking forward to meeting you in person. Thank you.
So thank you very much, Fawaz, and I'm also sorry that you're not able to make it in person. As Fawaz mentioned, we have three first-class panelists, all with a slightly different focus on the way that the capital markets operate. And I'd really like to start with Mazen, if I may, Mazen.
Sure.
And we've heard a lot about the situation in March 2020, the incredible volatility, the inability to value risk assets, the freezing of certain elements of the capital markets, secondary, CP, some of the investment funds, short-term money market funds, spring to mind in that respect. You may have seen the FSB report that came out yesterday on the way that the capital markets work. So clearly, it was an incredible month. It was a month to remember. And you are the corporate treasurer, and I'm sure that you've been preparing, ever since 2008 for such crises, but this perhaps exceeded all expectations, and the speed at which it happened may have done. But I'd be very interested to get your views as to how you had prepared for such a huge event and how you coped through the eye of the crisis.
Sure. Thank you so much, Martin, for the intro, and thank you for ICMA for hosting this event. And hopefully, as you said at the beginning, we'll be able to do it face to face next year, and we'll have all this thing behind us soon. Indeed, I mean, March 2020, as you just mentioned, will be a month for all of us to remember for years to come. And even though I worked through the crisis of 2008, and this has been different in the magnitude, I think, and the speed at which everything really unfolded. But at the same time, and in retrospect, I think here in the region we were a little bit more luckier, in the sense that we had to face the crisis a little bit early on, like in February, if you recall, before it really hit the US, because it was only that when the crisis hit the US that where that major turning point happened, and we have seen the impact firsthand on the world economy and on markets. So in a way, I say we were lucky, because I think we had those couple of weeks to anticipate that something was brewing and something was about to happen. Now, in terms of readiness, as you mentioned, as corporate treasury, I mean, by default, I feel that our job is to be doing the worrying on everybody else on behalf in the institution. Having been through 2008 and having been through different crises, the learning outcome every time is that it's liquidity. So no matter what the crisis is, and no matter how deep or big, it's always about, at the end of the day, it's about ensuring that the bank's liquidity is okay, and so in that sense we are always ready to, we are always anticipating something is about to happen. So since 2008, in addition to Basel III and all the changes that regulators have put in place, and the monitoring and then the stops that we have to do in terms of obviously monitoring the liquidity ratios on a daily basis, maintaining large buffers of diversified HQLA, running liquidity fire drills every now and then. The essential point, and if I were to summarize it, is we always need to have that what I call a well-oiled funding and liquidity machine that is always ready to act in a very fast and in very agile way. And that's especially true for us as a wholesale bank, where we need to have this as much as possible, as big as possible of and as a wide range of facilities in order for us to manage the liquidity, be it through diversified interbank lines, be it through having some funding programs like the CD programs or the likes. And given that we all need to have these large maintain HQLA buffers, I think one of the most important thing for treasuries is the having a very strong and well functioning repo desk that is proven time and again in every crisis, be it in 2008 or now, that it's always there to help you as a bank bridge that gap and manage that sort of sudden market disruption. So with that in mind, I can tell you that managing under COVID-19, we had to be prepared. So it was almost like a BAU situation for us, and I think most treasurers would tell you the same thing, with the exception, of course, that because it was so fast, I think we had to put tighter controls on cash flows. You had to ensure that communication across units, across the various, the front office, middle office, was happening much more frequently, much more intensely, to ensure everybody's funding needs are met, while the front office goes out there in the market and tries to secure the funding that is required at the most in a most effective way. But reflecting back on that as well, I think the only issue with this situation was that the outcome was, the uncertainty was great in March and April. We didn't know at the time how deep or how long the situation was going to be. So as a defense mechanism, the right thing to do, or the prudent thing to do for us, and what we did, is to be as liquid as possible for the foreseeable future. So, and that's kind of the reaction that always, that is always triggered in that type of situation, and that's what we had done in March. And just maybe to sum up, there's always a positive that comes out of crisis, even of the COVID crisis. And for us, the great thing is that it allows you to test all the assumptions that you have put in your ILAPs, all the assumptions that you have put in your liquidity fire drills, and so on and so forth. And you have clear data, new data that you can incorporate and make your assumptions better and be ready for the next crisis, because you always have to be ready for the next crisis.
That's very interesting, Mazen. It sounds like you were very well prepared, and the topic that or the concept that you're talking about, the dash for cash, we saw it in many banks, non-bank financials drawing down on their revolving credit facilities, et cetera, and banks needing to be prepared for that. And so I'd be interested to get a comment on that. And the other interesting comment that you made, which is close to our heart at ICMA, since we provide a lot of resource to the repo market, is the way the repo market functioned throughout the crisis. Do you have any impressions of that?
Absolutely. I mean, on the drawdowns of the revolvers. So again, as a first step, and in our preparation, the crisis, we didn't take any risk. We took the assumption that all our revolvers will be withdrawn. Do we have the sufficient liquidity? And if they were to go out, how much more liquidity do we have? So and that's how we operated, actually. And we assumed that everything is going out, and let's have that buffer over and above that. But what we have seen in the region, actually, we have seen some withdrawal, but they weren't anywhere near what we had anticipated. But yes, of course, we did have to provide for everything. Now, in terms of the repo, Martin, as I said, I mean, I used to manage the repo desk 12 years or 13 years ago, and when the financial crisis hit at ABC, and now I still oversee it under the corporate treasury. I cannot stress enough the importance of repo in an ALM activity, and this is why, actually, at Bank ABC we integrated it under the corporate treasury, Because yes, you can have the trading component, for profitability and all that, but when you incorporate it in your ALM activity, especially after Basel III, and especially after the fact that all banks have to have an HQLA portfolio to run for the liquidity buffers, it becomes so important that you have as many repo lines available to you, and as diversified geographically as possible, because what we also see in times of crisis, and as you know, for example, you have Canadian banks, they have their fiscal year that is at some point in time. The Japanese in a different I think in March or April, if I'm not mistaken. So when you have that diversity and that of lines, you are able. So there could be a crisis happening here, but the European banks are open and they have balance sheet to lend and so on. So repo is, I mean, my recommendation, if anyone doesn't have an active repo desk, to have that built in yesterday, and to have as many counterparties as possible. And we would love to be counterparties for anyone interested.
Very good.
Yeah, so I'm like you on that.
Thank you so much.
My pleasure.
I think repo is critical, and it's really the oil that greases the wheel of the capital markets. Now, I'd like to move on to you, Junaid. And as we mentioned, or I mentioned in the introduction, we saw massive concerted central bank intervention. We saw actually for the first time, we saw coordinated fiscal measures as well. We've now got the promise or the hopes that there are going to be a number of vaccines available. How do you see putting this all together? How do you advise your issuers in the capital markets to sort of navigate around some of these more difficult areas and to choose the right times to access the markets?
Good afternoon, Martin, to you, to all members of ICMA and the participants of this session. I mean, as you mentioned earlier in the beginning, that we would love to have the session on premise, on site, and have that much needed networking opportunity, but we live in different times, but good enough that we're not living in interesting times. So we need to bear that in mind. On your question, I think if we look at all the measures taken, let's go slightly back in history, back to the recent financial crisis of 2008 and 2009. In that particular year, the trigger event was more market driven. You had the undoing of the mortgage-backed derivatives book across the US, and then the fallout impact of that, whoever held those instruments across the planet. The resultant impact of that was felt on variable degrees. If you look at employment, productivity, revenue, profitability, business strategies, and government policies. What that ensued was you had global monetary centers executing historic cuts in benchmark interest rates, employing diverse liquidity and funding regimes for financial institutions. They went about executing multiple QE programs coupled with fiscal measures over several quarters. And the entire aim there was to revive growth, generate employment, investment, consumer spending, shorten the recessionary impact, boost internal external trade, and the penultimate objective being to have reflation in some form or manner across various economies. Now, this multifaceted or multidimensional strategy for most nations delivered either partial or, for many cases, no success. I think the only exception to the rule for this was the United States. And that continued from the Obama administration going into the Donald Trump administration, of course. And then 2013, 2014, because of the success they had witnessed, this motivated both the Fed and the US to embark on what was subsequently titled as budget sequestration, which is cutting down the expenditure as far as the budget was concerned, and a gradual reduction in QE leading up to the last 2 years of the Donald Trump administration. Fast forward to the present, where we are right now. COVID onset, Q1 2020, and you have monetary institutions once again embarking on the same bandwagon or employing the same tools and policy measures that they were forced to undertake back in 2008, 2009, but in this particular instance on a different scale and magnitude altogether. A historic reduction in benchmark interest rates going into negative territory for some nations while hovering at zero in others. Liquidity provision, monetary support, to sectors, to companies who were systemically important. So not just banks, we are going into the corporate space then. Record debt issuance. You've got subsidies being given. On top of that, the partial shouldering of the wage bill. So effectively, the government acting as the wage provider for its private sector and government sector employees. And all of this was done while in parallel, they hoped that the Medcare sector would develop an effective vaccine and we could bring a early closure to this tragic chapter in human history. Now, if we have either one vaccine or a series of vaccines that were to flood the market between now and first half of next year, the revival of growth would still largely be dependent on how successful that vaccine is in terms of its efficacy across various jurisdictions, and at the same time, how quickly the economies are resilient enough to go back on the track of growth and recovery. So it's a balancing act between success on the scientific front, with government hoping that they can time their measures and policies and declarations in an effective manner that you could instill confidence in both consumer and businesses that you can go about spending money and businesses can go about doing business-based investments. So for them, as far as the governments are concerned and policymakers, it will be to ensure that they do not overplay the situation and they do not undermine the situation at the same time and have that delicate balance, which is quite difficult to strike. But if they do, they will ensure that we will still have a U-shaped recovery. I second that opinion, but it will not be as painful as many would expect. In this context, the overall liquidity conditions will still remain fairly adequate, well-funded. So institutions, sovereigns, federals, corporations who intend to either refinance existing instruments or go out with or new debt, they will find favorable market conditions. So here, from that context, the liquidity conditions will be good enough for, as similar to the ones that we've seen this year, barring the period between March, April, and May, where there was heightened volatility. Conditions will be fairly good for on the issuance front as well as refinance. Now, there is one element of caution here, and that is that you have a democratic government in the US. Now, the democratic government, historically speaking, have always been inclined towards budget discipline. And I would err to side with that view that, be it President Biden or anyone else in that position, they would favor a return as quickly as possible towards budget normalization. But that does not imply that they will take away all the measures that were done by the Trump administration for in terms of the QE or excess liquidity or stimulus packages. But they would want to gradually have them taken out of the economy so that the economy on its own can generate revival and growth. So in the market sense, what I anticipate in the first half of next year is that the markets will start perhaps aggressively pricing in those measures more than what the market participants expect. So we could have a heightened spike yet again in yields, anywhere between 75 to 100 basis points. So for those who wish to come to the market with either refinance transactions or for issuance of new debt, they need to be wary of the timing. Right now, if you are doing an exercise to time yourself to the market for issuance next year, be wary of this one fact that you can have an instance of either a gradual or a sharp spike in yields. If it's gradual, it will be for the benefit of all because it will be just taken in the flow of things. But if you have a heightened spike, it would be temporary, but that will be a period where most issuers can avoid going to the market and subsequently return when things normalize. So liquidity and pricing will be fairly and largely attractive for those who wish to come to the DCM space. But they would have to be just cautious of this one particular element, that there could be that sudden spike that you need to just go across in terms of a hurdle impact. But if you have a sustained rise in yield, it's still good for the market. It implies that the underlying current is one of growth, and that growth is propelling rates higher, and that's a good story and a good place to be in. On the other side, emerging markets, I think certain countries who are well ahead on the path of growth and recovery, for instance, if you look at Japan, China, and Korea, they might have certain domestic challenges when it comes to issuance of local debt is concerned. So they would be inclined also to perhaps pursue, with the exception perhaps of Japan, they will be heightened. They will be inclined to pursue issuance in dollar-denominated assets rather than doing in local currency, for the simple reason that within their own domestic economies, inflationary pressures are very different, or will be very different from what their peers would experience in other parts of the world, mainly in the EU and the US.
Thank you very much, Junaid. Very interesting comments. I want to move on to Ahmed, but before that, just want to remind people, if you want to ask questions, post them into the Q&A section. And Ahmed, your focus is really more on the DCM side rather than the bank treasury side. And I thought it was very interesting to listen to Junaid about what is good advice from looking at the way the market's going to develop and how they would manage their own funding program. But I think you're involved in advising issuers, and I'd be interested to get your views on that. And also, one of the things we heard from Fawaz, we've had 120 billion of issuance this year, which is already bigger than greater than the 2019 full year total. So it'll be a very successful year for new issuance with a lot of mega deals coming through. That also implies a higher level of debt out there. Do you think that is likely to lead to any particular issues? And how do you see the market developing in 2021?
Thank you very much, Martin, and good morning and good afternoon to everyone, ladies and gentlemen. Of course, I mean, looking at the level of debt increase that we see in the region, it is natural for analysts to pose question marks or concerns around the trajectory there. However, in my opinion, one needs to look closely at the drivers of such increase in debt. So, number one, and as Junaid as well mentioned, there is a significant amount that has been done for either refinancing or actually pre-funding as well, 2021 early on maturities, especially given the uncertainty that we have been facing throughout the year. Just to put things into context, for example, there has been estimates that roughly 40% or even more than that of the supply this year has been for refinancing exercises. So there is, of course, a good portion of that coming in as new debt. Now, away from that, and it is also natural to see increased debt levels in year 2020, given the corona situation. And we've seen as well, targets of the impact of the pandemic have actually moved majority of the borrowers' objectives and previous strategies away from their ballpark targets. So in general, yes, higher debt quantums and leverage ratios could pose a concern, but particularly in my opinion, it is very important to actually see, especially in such market conditions, what is the delta from the increased interest servicing expenditure that an issuer would have versus the delta in the growth in revenues. And from there, putting things into context in our region, I believe that in the 2015 low oil price period has actually put our economies and countries in a better and a relatively more favorable position, where many sovereigns, for example, have announced fiscal balance programs. They have taken initiatives which focus on economic growth and also align their non-oil revenues to such growth. So, but of course, there is still some work to be done. And hence, for such an increase in debt that we've seen this year, it will be important to understand and put together a clear medium-term strategy that takes into account the current economic backdrop, what Simon has said as a potential U-shaped recovery in 21, and that is needed to be reflected by issuers on how they target to bring down a downward trajectory of debt rather than an increased trajectory of debt or rising trajectory. But so far, we did, of course, see strong liquidity available as well on the back of the central bank stimulus measures, which did enable many of the economy stakeholders and issuers to maintain funding and capex requirements by accessing the DCM space, as we've seen this year. And deals have witnessed strong investor demand across asset classes, across ratings, and we see as well a positive secondary market performance, which is looking strong and resilient. And we do hope that the fundraising activities, i.e. the increase in debt that we see, will result in a quick normalization of the economic performance, which eventually would trickle down to positive profitability indicators in 21 and a more resilient credit story for our issuers across sectors.
Thank you very much. I mean, that's quite an encouraging outlook from you. I think there are a couple of other questions I'd like to ask on some of the major themes that we are witnessing, and these are not for any specific individual. One of them is digitization. We're holding this on Zoom. I'd be interested to get your views as to what your banks are doing to embrace this particular agenda, whether you're seeing an increased level of usage, whether you're involved in an increased level of investment in some of these digitization solutions and capital market solutions. And perhaps since I see you still on my screen, Ahmed, I might just start with you on that one.
Sure. I mean, I think in general, the region has been lucky because we've been talking from a digitalization perspective about this topic since 2018 or even earlier. And a lot of initiatives were embarked since then. So it's a blessing in disguise that some of these initiatives were fast tracked as well during the COVID situation. And as a testimony, I think the number of work from home employees across banks, across sectors as well in the economy and the GCC has actually been high very early on in the process, or very early on in the COVID pandemic. From a capital market, and just to give you an example, I rarely now actually hold cash in my wallet. Digital payments are accepted by every retail shop in the country, and I'm sure the same as well in the broader GCC. And those transactions are going smoothly, and we see an increase in point of sale as well as in debit card digital, let's say, tokenization movements as well. Now, in terms of capital markets, despite the operational hurdles, and as everyone knows with debt capital markets, roadshows and investor meeting exercises are critical. It has been very smooth to use the technologies available to embark on such roadshows, for example, in a digital manner. They are more cost effective. One could debate whether they are effective from a point of view of reaching out and answering all the questions or reading the body language, etc. But in my opinion, what we've seen this year, at least, is that it was effective, and it could be a move forward where it would actually create benefits in enhancing as well, or reducing the time frame of issuances and being how much you are being exposed to the market. And we do hope to see, we've been using digitalization, the DCM space for a long period now, especially in the book building process, through the systems that are integrated across the joint lead managers and book runners, together with the issuer, for example, and the investors. But there are as well more movements happening there where we could potentially in the future see more automation, or let's say digitalization kicking in on the documentation front of these issuances.
Yeah. Okay, thank you very much. I might move on to the corporate treasurer side of this. Junaid, Mazen, any comments from your side on how you're embracing digitization in your banks?
Sure. I'll go if I may. At Bank ABC, I think 2016 or 17, digitization or the digital journey started and it is actually the core pillar of the bank's strategy. It's been like that for the past 3 years. And I'm not sure if you're aware, the culmination of that was the launch of ILA Bank here in Bahrain by Bank ABC in November of last year, which is a mobile-only digital bank that we launched here in the kingdom as a starting point, and with the expectation to launch it across the MENA. And it's been a success story. As Ahmed mentioned, the embrace of the utilization here in Bahrain has been tremendous. And the great thing about it is that you cannot this cannot happen in a vacuum, and the CBB was a catalyst. I think Central Bank of Bahrain was a catalyst and a leader in that space, which allowed us to succeed on that front, and has created this ecosystem around the island where you will most likely be seeing a lot coming out of Bahrain because of that. Now on the treasury and capital market front, the creation of ILA itself, the other impact is that the way it is transforming the bank, the traditional bank itself. Whereas, for instance, in ILA now, we can onboard a client literally under 5 minutes. The entire thing. You'll be at your home, with your mobile phone. You are onboarded. You create a bank account with I think now 6 or 7 different currencies. You fund your account, and boom, you're done. And obviously in the traditional bank, the process takes much longer. This thing is transforming the bank, and we are looking. Me personally, we are looking, and in Treasury we are looking at learning from that experience to bring that sort of digitization and automation to Treasury as well. So that's a journey, but we're definitely there.
That's very exciting. Thanks very much. I want to slightly change topic and move on to Junaid, if I may. And the other sort of mega theme, as we discussed earlier in the thing, is really sustainability and the growth of the sustainable bond markets. And Junaid, my impression is when I came to the Gulf, even at the beginning of last year, it was sort of an embryonic discussion, but I think things have moved on a lot since then, and I'd be interested to get your perspectives on how this market is growing and how the appetite for building sustainability into, across the entire piece is going.
Thank you again, Martin. I think it's a very, very important question here in the context of what we have been through and continue to go through with COVID-19. I think this period of March, April, and May, where the entire world was in some form of lockdown, gave a lot of time for people and companies to do a lot of introspection, soul searching, or define or project new directions for themselves in terms of how they run their lives and how they run their businesses. And in that sense, the importance of the environment, the overall social responsibility in various facets has just gained such massive prominence unlike ever before. At the same time, you had this undercurrent of various movements running, largely by the youth of the current generation. They try to highlight the significance of social responsibility of the environment in their lives and the lives of their elders. And that has propelled this entire argument that when we go about running our lives, spending money, raising finance, investing in business, you cannot simply be disconnected or allocate a lower priority to issues pertaining to the environment. Specifically in Q1 and Q2, we've seen that initially it used to be simply largely a marketing campaign. I'll be very honest on this. And something that perhaps would gain traction over time. But the events of the first half of this year have just propelled the entire argument in a different paradigm. So now you see banks as well as corporations who are willing to look at transactions which have an element of green in them, which are in some form or manner contributing towards benefiting society and the planet in some form or shape in the years ahead. We've seen bond issuances being tabled and managed by some of the larger institutions within the UAE and outside UAE from the broader GCC that had an element of the environment initiative behind it. Over the coming years, this will gain further prominence, an area that will be looked upon, investigated by companies that are in the aerospace division, even hydrocarbons for that matter. And I do remember a few years back, and not that long back, companies such as ADNOC enacted policies and measures to reduce their carbon footprint and do carbon locking initiatives. And what we've seen now is the further growth in that same thought process on how overall you can reduce the footprint of not just carbon, but any form of fossil fuel on the planet. And it's important for the region in the context of what might happen in the next 10 to 15 years as well. Because when you have global monetary institutions as well as banks, key global banks, who are looking at reducing their own exposure and support for hydrocarbons going forward in the next 20, 25 years, it implies that they will start employing the policies now and not wait for the penultimate years to be upon them. And that also then has a bearing on corporations and governments in this part of the world, that when they go about planning their budgets into the future for the next 3, 5, and 10 years, that what sort of support are they likely to receive from these institutions given their commitment to the environment. At the same time, local policies here, not just in UAE, Bahrain, Saudi Arabia, Kuwait, and across, are moving towards a different sort of direction. I think it has dawned on them well before COVID that the next 50 years will not largely be oil-based years. It will be an era in which you have to look at elements like digitalization, opening up new business opportunities, creating technology hives and villages, in fact, technology villages where you can explore different opportunities and create the sort of employment that right now perhaps is not on the radar. When you look at certain seminars and forums and they talk about two-thirds of the next generation of jobs are yet to be created, it just tells you how much of opportunity and potential is out there, and you need to be geared up for that opportunity right now. And from the financing perspective, green bonds is just that new variation that has come to the fore, but it will become a mainstay within all banks going forward in the next 5 to 10 years. And you will find more and more transactions which will have the economic benefit for both the issuer as well as the banks who are supporting the initiative when we see them coming to the DCM space.
Yeah, that's very interesting. I mean, we agree with you. We think the train has left the station and it's not getting back in. So it's just gathering speed. And it's not just the environmental concerns. I think the pandemic's been a catalyst, as said earlier, for social bonds, which are COVID-19 themed, to help economies rebuild. It's all about transition. I think this transition to net zero is important. We're going to be releasing a handbook of transition finance on the 9th of December. We released the sustainability linked bond principles, which build in KPIs into the entities' activities, and then they can issue a sustainable linked bond on the back of that. So I think there's a lot of good initiatives going through at the moment. Do you expect to see more corporate restructurings in the regions as the pressures of COVID play out in the economy? And how will this impact the markets and the appetite for GCC debt? Who would like to start on that?
Sure, happy to take that question. So the interesting element in the GCC, I would say, especially if we are looking to focus on the DCM space, is that the selection of issuers that we have in the DCM space are more or less the large size companies or government related entities or FIs. And when we look at that space, subject to the sector, of course, but majority of them are expected to be resilient versus the shock. Now, the impact over these, I would also expect to see that these credits are more resilient relative to other economies because of the measures that have been embarked by the governments in the GCC. Looking at the COVID situation, we see the numbers actually contrary to what we see in developed markets. The COVID cases are reducing, the number of tests are very high and very effective. And there is that positive containment effect that we see today. Economy is not looking or considering new shutdowns, for example. The main element, in my opinion, to assess how large restructuring will be required will be more of an element of how extent is the continued stimulus packages that will be provided either by the central bank, banks across the GCC, or even from the governments and continuing to support, for example, national payrolls or in the private sector, or providing additional stimulus measures. So but that said, as we see today, the banks in the region financing these credits are well capitalized. Liquidity is strong. And the solvency, of course, is very adequate as well. So there could be some conservativeness seen in 2021 by financial institutions foreseeing some of that impact on the actual true retail economy, for example, especially in sectors like the hospitality, the airlines, as well as tourism. But overall, you might see conservative provisioning coverage coming into the banks. But in my opinion, it's not a high risk for the overall GCC to worry about the extent of restructurings that will be required.
That's also very encouraging. Thank you very much. I think we'll move on to the next question. This is going to be directed at both of the treasurers on the panel. And it's really to develop some of the discussions about the digitization agenda. And this is the interest that you two might have in new trading platforms in the short and medium term, with a focus on money markets and repos and sec lending, so really at the short end of the curve. Is this something that you're particularly focused on?
I mean, at our end, I mean, well before, as I mentioned, the onset of COVID, we had embarked on our digitalization journey across the bank, both in corporate, retail, as well as on the treasury front. So within the space of financial markets, money markets, and treasury as a whole, we have looked upon and working upon various initiatives. Having your own EFX platform, I think, is the way forward for most FIs. There are several FIs within the region who are yet to embark on this journey, but I think time is of the essence. With the establishment of digital banks, it's inevitable that if you do not have an EFX offering for your customers, that you will be left behind. And as you mentioned earlier, the train has already left even as far as this subject is concerned. On capital and money markets as well, we've engaged with through the FinTech Hive initiative with some firms who've offered some very attractive opportunities that could then equip not just the corporate but even the retail customers to participate in fixed income instruments in the secondary market in a very tech heavy way. So for instance, rather than completely be reliant on specific deal sizes, which are generally large in nature, you could have retail and corporate investors buying into partial tranches of what's available out there in the secondary market, with issuances ranging from GCC, EM, and in some cases even investment grade. So those sort of opportunities and platforms are out there. It's important for banks to embrace them as early as possible. Otherwise, the peer banks will do that, and you will find that the customers will then anchor towards the institutions who do have a more digitalized product offering, service offering, compared to the normal standard suite of services that we've seen in the last 3 or 4 decades. Coupled with it is the fact that you also have certain platforms being made available that provide you liquidity in the form of deposits from various jurisdictions. Those are technologies right now available, which certain banks are looking at. We are looking at those ourselves as well. Again, they contribute to the ALM initiative, as Mazen had mentioned. To a certain extent, they could even anchor in to your repo-based activities and repo-based objectives, and how they would translate into benefits in terms of both ILAP and ICAP. Mazen, over to you now.
Sure. Thanks, Junaid. Yeah, I mean, I echo that. From our side, yes, we did launch an EFX platform that we provided our customers, and again, I mean, this is the trend, and you have to respond to customers' needs, and you cannot but provide and adopt these types of platforms. As I mentioned, because we have so many digital projects, digitization projects going on across the board. So we finalized the FX platform for Treasury. We are looking very closely at some of the things we can do on the collateralized lending space. We haven't adopted anything yet, but again, as Junaid mentioned, I learned of a company in Singapore that recently launched that. It's a fintech company that allows fractional investment in bonds for retail investors, and that's huge, I think. And so we what I would say, just to in a summary, we are monitoring very closely. We will definitely be adopting something. We also adopted one platform that allows us for liquidity, basically for CDs and money markets based in Europe, where we are able to get pricing and trade with investors there. But we would like to do more, especially on the repo and collateralized lending. But we're monitoring closely, and hopefully we'll be doing something soon.
Very good. Well, look, I think that leaves me with just one a very short question when I'm expecting a one-sentence answer from all of you. You're all involved in issuance in one way or another in the debt capital markets. And I want to look ahead to 2021. And do you think that the market will be more receptive in 2021 than it has been since the central bank intervention in 2020? Or do you think it'll be the same, or do you think it'll be less receptive? I'm going to start with you, Ahmed. It's close to your heart, I'm sure.
Yeah, I mean, in a nutshell, I think it's important to see the continued intervention by the central banks just to make sure that we do normalize the economic performance as soon as possible, especially as we are expecting to see some turbulences early in the year with potentially some technical positive periods coming in early in Jan to mid-Feb because of any correction that we see from the holiday period demand coming into developed markets and how that would trickle down to our fixed income economies here or markets here. But then to the extent of how, to Junaid's point earlier, how viable is the distribution or effectiveness of these vaccines and the results that we see coming in to trickle down within H1 2021. And thereafter, you could see some fundamental improvements coming in and improving the markets. And hopefully from there, central banks can revisit their, not only central banks, but governments, not also on the fiscal measures to look at revisiting or reducing that stimulus support.
Thank you. Junaid, very briefly, any closing comments
Indeed.
on expectation of 2021?
Indeed. I mean, just to follow up on what was just said by Ahmed, I do believe that the governments, albeit on a no-choice basis, will pursue these this quantitative easing policies and hope for a reflation of the economies at the earliest. The overall debt capital market will remain buoyant. There will be that surge in demand because there is a shortage of assets out there. Corporate assets are not growing as aggressively, so that money needs to find a home. So you have excessive QE with no money to be parked in the form of your traditional corporate assets. The only home for these would be either in the form of fixed income instruments or your equity market. So the market will remain resilient and buoyant going forward into 2021.
That's encouraging. Very briefly, Mazen, last comment on the panel.
Sure. Well, first of all, thank you so much for hosting the panel. And as a closing remark, I echo both my colleagues' sentiment on the demand. It's a combination of ample liquidity, low cost of fund, and no asset growth. So there will definitely be demand. But again, I think I'm positive for 2021. But we remain vigilant. We have to remain vigilant because we're not out of the woods yet. And thank you so much.
You're all very positive. I very much hope that you're right. Look, I want to thank the panelists very much. It's been a very wide-ranging discussion there. We've covered, what happened this year. We've covered the central bank intervention. We've covered the way the debt capital markets operated. We've looked ahead to 2021. We've covered two of the main themes in the market, digitisation and also sustainability. So a very packed panel. We could have gone for ages. So I want to thank you three very much for your preparation and your input today. Very helpful for all of us online, actually. And I think all that remains for me now is to ask Amin Belhaj Sulami, who, as I said, is based in Bahrain and works for BNP, but importantly for us, is a board member of ICMA, to say a few closing comments.
Thank you very much and good afternoon. My name is Amin Belhaj Sulami, and I am the head of Middle East and Africa at BNP Paribas CIB. As a board member at the International Capital Market Association, it is my privilege to make a few remarks to close our virtual event today. This event has been a great opportunity to hear expert views of our esteemed speakers and panelists on the major themes which are driving developments in the debt capital markets of the region. The discussions around the replacement of LIBOR and the rise of ESG finance were particularly instructive. And of course, no discussion in this extraordinary year would have been complete without reference to the COVID-19 pandemic. Issuance in the first half of the year from MENA increased to $46 billion, accounting for 34% of total emerging markets to cushion impact of coronavirus and oil price decrease. Social bonds, which ISDB has been a frequent issue of, can play a pivotal role here. As you will know, ICMA has been involved in the green and social bond markets since the early stages of the market, and its work continues to evolve with the recent issue of new sustainability-linked bond principles, further developing the role that bond markets can play in sustainability. It will be interesting how MENA markets will address the wider sustainability discussion. We see that Egypt, for instance, has issued its first green bond in MENA. Nonetheless, it's pleasing to note that capital markets have remained largely robust and functional throughout and are well prepared to do their job financing the economic recovery. I would like to thank all our speakers and panelists today, particularly Fawaz Abu Snaina, for his able chairmanship of the ICMA Middle East and North African Regional Committee. Thanks also to Martin and the team at ICMA for organizing the event and for adapting swiftly to the new normal this year to deliver a complete schedule of virtual events for our members. I'm also pleased to see how the membership is developing in the MENA region, with development banks joining, such as the Islamic Development Bank and Egypt-based African Export-Import Bank. Finally, thank you to all of you for your virtual attendance today and for your valued support throughout the year. None of ICMA's work would be possible without the continued commitment of its members.
Thank you all for participating today.